Imagine two people born on the same day, same country, same intelligence, same work ethic. 30 years later, one owns assets that quietly earn more in a year than the other earns by working full-time. The other is still waiting for things to finally pay off. Nothing dramatic happened. No lottery win, no scandal, no single bad decision. Just timing. That's the uncomfortable truth most financial advice avoids. Wealth is not primarily decided by how hard you work or how smart you are. It's decided by when you arrive, relative to how the financial system is distributing money at that moment. And that timing advantage isn't random. It's structural. It's built into how modern finance works. This is the quiet mechanism that decides who gets rich first. And once you see it, you can't unsee it. Right now, we're living through one of the most confusing economic moments in decades. Asset prices feel detached from reality. Wages lag behind everything else. Debt keeps growing, but the system insists this is normal. Some people seem to glide upward effortlessly, while others feel like they're running in place. It feels unfair, but more importantly, it feels opaque. So let's slow this down and strip it to something simple. Modern wealth doesn't start with effort. It starts with access. Specifically, access to money before it spreads through the economy. To understand that, you need to forget how money is usually explained. Money does not enter the economy evenly. It doesn't show up everywhere at once. It moves in a sequence, and the order of that sequence matters more than almost anything else. Most people imagine money creation as something abstract. Central banks print money, interest rates change, markets react, and eventually wages and prices adjust. It sounds neutral, almost mechanical. But in reality, money enters the system through very specific doors: banks, financial markets, governments, large institutions. That's where new money appears first. When central banks inject liquidity, cut rates, or expand balance sheets, that money doesn't flow straight into everyday spending. It flows into financial channels: asset purchases, lending markets, government bonds, corporate financing. The first people to interact with that money aren't workers, they're asset holders. This is where the mechanism begins. Imagine money as a wave moving through the economy. The people closest to the source feel the force immediately. Everyone else feels it later, after it's been diluted, redirected, or inflated away. When new money enters financial markets, asset prices respond first. Stocks rise, real estate appreciates, bonds reprice, risk assets inflate. If you already own assets, you don't need to do anything. Your balance sheet changes quietly, automatically. If you don't own assets, you don't feel richer. You feel nothing. At least, not yet. Eventually, that money works its way outward. Companies hire, governments spend, consumers spend, prices rise. By the time wages adjust, the early gains are already locked in. This is not a conspiracy. It's not malicious intent. It's arithmetic. The system rewards proximity to capital. And proximity is determined by timing, not merit. Let's make this concrete. Take a period of low interest rates. Borrowing becomes cheap. Asset prices rise because future cash flows are discounted less. Investors can justify paying more today for returns tomorrow. If you own assets before rates fall, you benefit immediately. If you buy after prices rise, you're paying the premium. Same asset, same return, very different outcome. Now, stretch this across decades. People who entered housing markets before major credit expansions experienced wealth growth that looked like genius. People who entered after faced higher prices, larger debts, and thinner margins. Not because they were worse decision makers, because they arrived later in the sequence. This mechanism has a name in economics, but you don't need the term to understand it. You only need to understand order. First receivers gain purchasing power. Late receivers absorb higher prices. That's the entire engine. And it repeats every time the system expands. Here's where it gets uncomfortable. Most public narratives about wealth focus on behavior, budgeting, discipline, hustle, optimization. These things matter at the margin, but they're not the primary driver. The primary driver is positioning within the flow of money. That's why two people can make equally smart choices and end up in completely different financial realities. One bought assets before a liquidity wave. The other saved cash during it. One benefited from price inflation. The other paid for it. This is also why inequality often widens during periods of monetary expansion. It's not because everyone suddenly becomes greedier. It's because asset ownership is unequally distributed, and asset prices are where money lands first. The system doesn't distribute opportunity evenly over time. It distributes it sequentially. And here's the irony. The later you arrive, the more responsible you're told to be. You're told to save more while prices rise faster than wages. You're told to invest carefully while valuations stretch. You're told to be patient in a system that rewards early exposure. This creates a quiet psychological tension. People blame themselves for structural timing disadvantages. They think they missed something, that they didn't learn fast enough, that they made the wrong choice. But the math was already moving. Now, let's go one layer deeper. This mechanism doesn't just decide who gets rich first. It also decides who takes the most risk. Early participants benefit from asset inflation with relatively low leverage. Late participants are forced to take on more debt to access the same assets. Same house, same stock market, different risk profile. As prices rise, entry requires leverage. Mortgages get larger, investment risk increases, small downturns become dangerous. So the people who arrived last don't just earn less upside, they absorb more downside. This is how financial fragility builds quietly. The system looks stable on the surface. Asset prices are high, credit flows smoothly, confidence is strong. Underneath, risk is being concentrated among those least able to absorb it. This is not new. It's happened repeatedly. Before the 2008 crisis, credit expansion inflated housing prices. Early buyers accumulated equity. Late buyers accumulated debt. When prices fell, the losses didn't distribute evenly. Before inflation surged in the early 2020s, asset prices surged first. Wages followed later, unevenly. Those with assets saw balance sheets grow. Those without saw purchasing power erode. Same pattern, different decade. And here's where modern finance makes this mechanism even more powerful. Financial markets move faster than the real economy. Capital can reprice instantly. Labor cannot. That speed gap amplifies the advantage of early access. By the time policy shifts reach everyday life, markets have already moved on. This is why you often hear phrases like, "the market is forward-looking." That's true, but it's also revealing. Markets react to money before people do. Now, contrast this with how wealth is usually portrayed. We're told that markets reward insight, that success comes from understanding trends, picking winners, staying disciplined. But much of the return comes from simply being there before the wave. That's not an argument against effort or learning. It's an argument against pretending timing doesn't matter. Timing is the invisible variable no one likes to discuss because it undermines the idea of a level playing field. And once you acknowledge it, a lot of advice starts to sound hollow. Just invest early only helps if you can invest early. Just buy assets only works if prices have already run far ahead of incomes. This is why younger generations often feel like the game is rigged even if they can't articulate why. They're not wrong, they're just late to a system that already distributed its biggest gains. Now, zoom out even further. This mechanism doesn't just operate within countries, it operates globally. When global capital flows favor certain regions, currencies, or markets, those closest to capital hubs benefit first. Others receive the effects later, often in the form of inflation, debt, or volatility. This is how global inequality compounds. Money doesn't just move unevenly across time, it moves unevenly across space. and the institutions that sit closest to the source, large financial centers, reserve currencies, deep capital markets, capture outsized advantages. Again, not because of morality, because of structure. The system rewards proximity to money creation. So, where does this leave the individual? Here's the part that rarely gets said clearly. You cannot fully opt out of this mechanism, but you can understand it. Understanding doesn't guarantee wealth, but it reframes reality. It explains why doing everything right can still feel insufficient. It explains why wealth outcomes cluster by generation, geography, and entry point. It explains why asset booms feel inevitable once they start and painful once they end. Most importantly, it forces a different question. Instead of asking, how do I work harder,